Hello, everybody, and welcome to VRIC Media, your most trusted voice in metals and mining. As always, we're bringing the VRIC to you each and every week with our series of expert online panels. We've got a part two for you today. It's Jack Gamble, the host of the Nobody Special Finance YouTube channel, and Melody Wright, founder and publisher of the M3 Melody Substack. We're going to talk about the housing market and its implications for the economy. It is great to have you both back for part two of our discussion.
Thank you, Jesse. It is a pleasure to be here. And hi, Melody. It's good to see you again, as always.
Hello, everybody. It's great to be here.
Yeah, and the audience greatly appreciated the first discussion. It is one of the most popular panels on the channel to date, so very excited to dive into part two. Let's start off with a broad picture. I want to ask you both, what are the main trends you're watching right now when it comes to the housing market and the implication of those trends for the economy at large? Jack, I'll start with you on this one.
You know, I was really hoping you were going to start with Melody on this one. I'm not going to lie, because Melody is she just really kills this whole category. But I'll tell you what I watch, and it's always been two things in particular. Affordability and employment are the two biggest things that inform home prices. All right. Affordability, no big surprises there. Interest rates are what they are. Cost of living has risen. I think one thing we're not really factoring into the discussion a lot with home affordability over the last year and a half, 2 years or so, isn't so much what home prices have done. It isn't so much what debt to incomes have done. It's what the price of everything else has done, because car insurance got more expensive, cars got more expensive, fuel, food, everything else. So just with home prices staying flat, homes have become less affordable because of the price increases and everything else. So I think that's one category that doesn't really get enough attention. Melody has made some great points about FHA loan fraud, and I think we'll get to that later in the show. We'll hash that out in more detail. And the other thing that I have really noticed in just the last couple of weeks is a little bit of a subtle shift in the narrative in Washington. Whereas for the last several years, we've heard a lot about how the government was going to try to make homes more affordable, all these programs about affordability, which, every time the government gets in the business of making things more affordable, they have a funny habit of getting more expensive. There's a very different nuance to that now. President Trump and members of Trump's administration, like Secretary Bessent, have talked about bringing home prices down. Now, it sounds like they're saying the same thing, but it's totally different. When you hear about home affordability, you're usually talking about forbearance programs, down payment assistance, all these things that make home prices rise. What President Trump is talking about doing, and President Trump's people are talking about doing, is actually bringing prices down. It's a very subtle change, but I think it's an important distinction that a lot of people are glossing over.
Great thoughts. And Melody, what are you watching right now when it comes to the housing market and its potential implications for the economy at large?
So, Jesse, I watch everything, which is, to really triangulate what's going on, because as Jack was kind of referencing, a lot of people look back to the last crisis, right, and are fighting the last war and have been thinking for years, ultimately, we're going to get these foreclosures. Well, that was just not in the cards under the last administration. And so, I'm like Jack. One of the things I'm really watching right now is the narrative, because we know that the housing market was sustained purely on narrative last year. It was the worst for existing home sales in over 30 years, and we've increased population by over 20% since then. So that is just absolute insanity. So I'm watching the narrative, because despite that, people still didn't realize how bad it was out there. And what I'm seeing, just like Jack, is that they're making announcements that really are sending a signal that the days of all that down payment assistance, the days of all of that hand holding in the housing market are coming to an end. And something I've said to people recently is that foreclosure is about to be sexy again. And, when I say that, I'm sure there's plenty of people out there that are worried about our vulnerable Americans that, are going to be in this position. But I want to caution them that really what I'm seeing right now is a lot of investors and speculators who are in distress because they bought properties illegally using the FHA program, which only requires a 3.5% down payment and sometimes less, depending. So it's zero skin in the game, and they're walking away. So to me, right now, I've been watching this housing market. I've been driving across the country, but what really matters are two things. One, what's happening in the stock market, because one of the reasons 2024 had the sales that it did, and you saw that median home price sustained, was that our top 10 to 20% were still transacting. So, but now what you see in the University of Michigan consumer expectations is that we had the bottom of the K and the middle of the K were already they were feeling pretty badly about the economy. But what you just saw in the recent survey is that top just came down like this. And I also think that the message has been received that being a landlord is not fun anymore. You've got rising property taxes, you've got rising insurance if you can get it, those replacement costs, and then your debt burden. And so what we started to see last year, and it is just accelerating. I cannot emphasize how bizarre all of this inventory growth right now is. You typically do not see this kind of growth. So there's a lot going on. And if the stock market continues to kind of fumble here, then I think that top 10 to 20%, there's a lot of headwinds. They're not going to transact anymore. But on the lower end, the other thing is people are in distress now. They've used up, the people with lower balance loans have used up all their benefits, and you're starting to see them come across the dam. And we are starting to see foreclosure starts. And so this isn't something I ever really factored into my analysis because it felt like the government was going to extend forever. And that's certainly what it's, seemed like. But we're now actually seeing them. Foreclosure starts are up, over 20% year over year. So watching the stock market, watching the narrative, watching foreclosures, watching sales. So trying to watch all of it. But the narrative really is, in my opinion, the most important thing we've seen in the last couple of months.
Well, I'm going to go back to you again, Melody, for this one first, because I want to pose the question of the credit cycle and where it's at the moment when it comes to mortgages and the rates that are being offered. Are conditions loose, tight, somewhere in between? And what are the implications for those who are entering the housing market today?
Yeah. So in terms of are the agencies or the banks pulling back? Not really. You're seeing a lot of really special offers like get in, come on, you got to be the last one in the door, come on in. But effectively, the consumer is not able to qualify. So, one stat we just got out of the New York Fed is that mortgage refinance rejection rates were 41.8%, up from 27% last year. They've never seen anything like that since they started tracking that in 2013. That is massive. It means that everyone that thought they had all this equity cushion, right? Because that's all we've heard for 3 years, 4 years. Look at all that equity. Look at all that. I could talk a lot about the fact that that doesn't exist for several reasons. But if you can't access it, it doesn't matter. And if you can't sell for it, that doesn't matter. And what we're seeing is properties aging, sitting on market. The overall national average is around 61 days on market right now, but markets in Florida, Texas, California, many markets, they're just aging, and you can't sell.
And Jack, I would like to pose the question whether the stock market, particularly the broad market, has any connection at all to the housing market. Can both be tracked, and can information be gleaned from, for example, the stock market performance? And does that project anything to do with housing? Is there any connection there? And if so, how does one parse through that data and figure out where the future could be headed?
So there's a common denominator between the stock market and the housing market, and that would be the bond market, right? Liquidity, availability of credit in the bond market informs the direction of stocks and the direction of housing. I would have to come back to the bond market as the common thread to pull on here. Now, this common narrative from the Federal Reserve is that financial conditions are sufficiently restrictive to bring inflation back down to our 2% target, even though they still have not hit their 2% target. It's 2025, and we're still well above that. You guys going to get around to that at some point, maybe, hopefully. But I have to address this sufficiently restrictive policy stance that I keep hearing from the Fed, because I got to ask, are these restrictive monetary conditions in the room with us now? Because they don't exist. Two particular data points. The Chicago Fed Financial Conditions Index, all right, it has been in decline. It's been becoming more accommodative since October of 2022, which was only 6 months into the Fed's QT cycle. All right, now this obscure data point, this Chicago Fed Financial Conditions Index, it's made up of over 100 different data point inputs. It's a very comprehensive indicator, but it's been declining for 2.5 years. The whole time, the Fed has been supposedly moving restrictive and actually stopped moving restrictive and then started becoming more accommodative again right before the election. But the whole time, these financial conditions never even went into positive territory. Even at the height of the Fed's restriction, we were still technically accommodative. Now, the other data point that's very important, and again, we're talking about the bond market, which is the common thread between the two, is the money supply, the M2 money supply. Now, since October of 2023, the money supply has been increasing. Supposedly $1.2 trillion of new money has been poofed into existence the whole time the Fed has been doing QT. The Fed is still doing QT, so the money supply should be shrinking, but it's not. So how do you have both conditions simultaneously? How do you have the Fed shrinking base money while broad money, the M2, is growing? That's credit expansion. And credit expansion doesn't happen in restrictive monetary conditions, which means conditions are still accommodative. So that's why I ask, are these conditions in the room with us? So when you've got a money supply increasing through credit expansion while the Fed is shrinking the amount of reserves in the system, to use a metaphor, you've got the market is moving out further on the branch while the Fed is at the trunk cutting into the branch. So we're more levered than we were before this whole thing started. That's why prices haven't come down. It's not because the crash bros have been wrong about everything. It's because this dirtbaggery has been getting worse and worse. The market is avoiding price discovery at all costs, and they're doing it by increasing leverage, which ultimately makes the corrections more severe.
So obviously, the market can remain irrational longer than you can remain solvent. And this does seem to be a situation, though, where things are headed eventually in the wrong direction. Do you think we could see a significant crash, a significant downturn in the real estate sector, an all-out bear market perhaps? Do you see that happening? And once that dust settles, or as prices drop, is that a good time to enter the market as an investor or a speculator? Or is there a danger of trying to catch a falling knife in that scenario? Melody, what are your thoughts?
So, Jesse, I've started to look at this housing market very differently than when I first started. And I think that we've actually been in a bull cycle since the 90s, the early 90s. I think this started with Greenspan. And I think that during the GFC, people really, that subprime wasn't about, giving it to low credit quality families. It was more about non-traditional products to investors yet again. And so I think what happened during the GFC is some people got burned, but not enough. And those who were too big to jail essentially realized, they learned some lessons and then got a lot more aggressive. And in fact, the government agencies invited them in. Wall Street is who saved the housing market. It would have corrected much more had that not happened. And Wall Street came in. I was at those auctions buying up those homes to do long-term rental. And so I think, before the 90s, housing prices forever looked just like this. Henry Ford talked about, if you work in my plant, I want you to be able to afford my car. And so it was really the same. Houses were shelter, and that's all they were. And so I do believe that we are in for a serious correction, barring some kind of exogenous event and the UFOs coming or something like that. We have to, you can read the stats all day long, but I would encourage people to take 20 years of home prices, median home prices, and take 20 years of median income. And if you do that math, you won't throw tomatoes at me anymore. There, we are just simply at a point of complete unsustainability. And at the same time, the people that can't afford those homes are saying, why bother with extra homes? This is such a pain. And so I do believe that we are entering already correction territory. It always starts in certain states. It's not like all of a sudden everybody wakes up nationally and says, oh, it's time. No. And it always starts in Florida, by the way. And so we've got Florida and Texas, and California is joining the party. And so, to your question about is there going to be a time when people can get in? Absolutely. And that's going to depend on your local market. I track 90 cities. You need to look at your demographics, you need to look at comps and things like that. And you need to be very, very careful, but it always comes down to your long term goals. If you're going to be in your house for 10 to 15 years, that's a very different decision than I want to buy for 2 years or 2 to 5 years. So, yes, I do think there's going to be opportunities. I think there are already some in certain very specific locations, but this spring selling season is going to be a real interesting one. And I think what we're probably going to see is non-seasonally, home prices are not going to be rising like they typically do every year, especially if rates continue to come down like they have been in recent days. That's actually going to bring the lower end in, which is going to impact those home prices as well as those foreclosures that are starting. So that was a long answer. There will be a time, but people do need to be very, very cautious and make sure you're looking at the macro as well as the micro picture.
And Jack, are you seeing the same picture being painted when it comes to the housing market broadly? And if we were to see a massive correction, where is it in the market that you would be looking for opportunity? That could either be, like Melody says, in your local area, or perhaps some sort of financial instrument, a REIT, something like that. Where would you be looking in that scenario?
So I agree with Melody's assessment. It's interesting. She mentions California and Florida. Florida's kind of interesting because Florida has been the beneficiary of the aging demographics for the last 20, 30 years or so. That is going to start shifting. Yes, we're still aging, but I think without getting too morose here, you're going to have more people attriting out of the senior citizen population than aging into it very soon. And that's probably not going to be very good for your Florida local markets. I would also add Arizona to Melody's list of states to keep an eye on. That's one that they're still building like crazy in. Arizona has been the beneficiary of the decrepit conditions in Silicon Valley, in San Francisco, and cities like that. People are just running from that. And Arizona is one of the states they're running to in the Phoenix, Scottsdale area. So that's going to be a market that's going to be highly levered to whatever happens in tech. And I do believe we have a ridiculous tech bubble in stocks right now. I've talked a lot about that on my channel. So that could kind of kick it off. What's happening in stocks could kick off in one of your booming housing markets in Arizona. Now, as far as the opportunities, and you use the metaphor of the falling knife, I would say as always, don't try to catch a falling knife. Let the Fed catch the knife, because we don't know where the Fed is going to catch the knife. They've caught it before. They always do. I hope they don't. I hope they let it fall until it hits the floor. But that's going to be your signal. When the Fed steps in, when they start buying up these troubled assets again, when they start shoring up liquidity operations, whatever language they use to pump money into the system, that's going to be the signal to the market when it's okay to start buying in again. I don't know when they do that, but absent some action to support asset prices by the Federal Reserve, you just let that knife keep falling. That's my opinion.
Well, you both recently did a video on the Nobody Special Finance channel about fraud in the housing market. You touched on it in the introduction to this interview. I want to read the description of that video to paint a picture here. Millennials and Gen Z are being denied the dream of home ownership due to widespread fraud and abuse of COVID-era programs meant to prevent people from losing their homes. Walk us through this story. How is this system being taken advantage of? Will people be held accountable, and what are its impacts on the housing market? Jack, I'll start with you on this one.
So this FHA fraud, and the only reason I caught wind of it was because of Melody's work on this. It just blew me away. Melody has been way out in front of this since 2023. I'm sure it was sooner than that. That's when I first started seeing Melody's work. There was a report in January of 2023 from the Philadelphia Federal Reserve that talked about how common occupancy fraud was with FHA loans. An FHA loan, you're only allowed to take those out if it's for a primary residence. And the Fed estimated an astronomically high percentage of FHA loans were actually for second homes or investment properties, rentals, Airbnbs, which means fraud, a significant portion of this market. And Melody could correct me on the number. It was something like 40 to 50% of FHA loans they suspected had some kind of occupancy fraud happening.
About
and then
30,
more,
but
I'm sorry, 30, was it?
yeah, 30.
Thank you.
Mm-hmm.
Very high, right? When 30% of a market for something is fraud, fraud is the market for that. Now, on top of that, what a lot of people don't realize, and Melody's done a great job, along with a guy named John Comiskey, has highlighted this COVID era program of loan workouts that I'll let Melody explain in more detail has allowed people to get away with not paying their mortgage for years in a row. And what's happening is you don't pay your bill after so many months. Instead of foreclosing on the house, they just give you a no interest loan. They create a second lien on your house and they tack it onto the money you owe. And again, I'll let Melody get into the finer points of this. But the statistic that really drove me nuts in this Wall Street Journal article, in 2024, there was 52,000 and change of these FHA loans that went seriously delinquent, 60 days past due, so 2 months, no payments, in their first year of the loan. Just bought the house, already 2 months past due. Out of 52,000 loans that did this, 9 went into a foreclosure. Not 900, not 9,000, 9 of them. Foreclosures have effectively been banned by this silly COVID program that's still in effect. One of Biden's last acts as president was to extend it into 2026. And one of the big questions about, when I talked about the Trump administration possibly bringing home prices down, is if they were to terminate this program, you would instantly start seeing a wave of foreclosures from these tens of thousands, maybe even hundreds or millions of homes that are delinquent that should have hit the market at fire sale prices, but we're just not letting it happen.
So Melody, break that down for us in more detail. Why aren't these foreclosures occurring? What is the clause in these loans that is allowing this to happen? And since so many are fraudulent, why is no action being taken at this point in time?
There's just no incentives right now, Jesse. I mean, there's no incentives. So the servicers actually are incentivized to keep doing the workouts. Now, I know these servicers, they're not making bank on this. In fact, they're barely keeping their head. Most of them aren't keeping their heads above water on servicing, but you get a payout every time you do one of these workouts. And effectively, just as Jack had said, foreclosure became completely taboo. Like it was, and it's so funny because you have, the government market is huge. They own about 85% of all outstanding mortgages. But even that 15% of private investors were terrified. They would get in trouble because what happened during the GFC is all the state AGs kind of came in and then they colluded with the CFPB and other government agencies to really put a lockdown on foreclosure. Some states paused foreclosure altogether. And so since that time, it has really been not seen as kosher to foreclose. In fact, what the agencies do is they sell their non-performing loans. So anybody, Jesse, that says to you, well, that's just FHA. Look at the prime, Fannie and Freddie. They look just fine. Guess what, folks? That's because they've been selling the non-performing loans off to hedge funds that we don't have any information on how those loans are doing right now. The closest thing that we have is the Census Pulse survey that they do. It starts up in April for a few months. Last year, it said over 6 million borrowers were behind and thought they might be near foreclosure. So that is a huge number that's not being reported anywhere else. The Fed only tracks delinquency at the commercial banks. And so these programs have it's just extend and pretend. And, they put a pause on what really should have happened in 2024 and really 2023, because as Jack said, and it's so funny, sometimes people can say things I just can't say when I'm in the middle of it. He's just like, wait, COVID was over a long time ago. And that is exact. So why are we continuing to do that? I mean, Jesse, everybody says the unemployment is low, labor's great, economy's great. So why are we just giving people the opportunity to not pay their mortgage? So I won't get into all the details of these programs, but put it this way, that order that Biden signed a day before Trump was inaugurated effectively put the pause on will have put the pause on many, many foreclosures this year if they don't stop this program.
So then, assuming they don't stop it in 2026, the program officially ends. At that point, do you both expect to see a wave of foreclosures? Jack, what are your thoughts?
As far as a wave, it's probably not going to be an immediate deluge. We saw this after the GFC, the zombie homeowner phenomenon, where the banks just kind of dragged their feet and let them linger for a couple of years. But I do think you are going to start seeing foreclosures rise. How fast they rise is going to depend on how much price discovery the market can stomach. And right now, the market cannot stomach hardly any price discovery. So it's very hard to tell how fast it's going to hit when that program ends. Maybe Melody could put more light on that.
Even if they stopped it, right? Like I was just saying, the state AGs, think about which states likely would do this, can come in and do all kinds of things to slow these things down. And by the way, the counties cannot handle it. They are all, the municipalities are suffering right now. They got like 300 billion in the CARES Act, and they started living large and they got used to that money that's not coming anymore. So you have many municipalities that are suffering. And I say this because a lot of these homes aren't actually on the books of banks. And so the counties are going to be, so people may not know this, but when you go delinquent on your taxes, the county can foreclose on your home and take it. You're going to see a lot of that as well, because there's a big unknown, Jesse, with what I call private note sales that have been happening outside of your traditional system to kind of as workarounds to higher rates and rising default. And so there's a lot we don't know. And I think those are actually going to start increasing, and they're not on banks' books. We don't really know anything about them. So a wave of foreclosure, I don't think so, unless things drastically change, but we don't need a wave. We just need a few, and that makes all the difference. And in fact, in places like Georgia and Texas, where foreclosure happens very quickly, not so in many states, but Texas notably, I think you are going to see an influx, I would say, as opposed to a wave of foreclosures. And we are just going to start increasing from here. Like I said, those starts are already up. Depending on the state, it could go very fast, 60 to 90 days. In New York, 3 to 5 years. So it really is location dependent.
And so what steps need to be taken to return the U.S. housing market to a healthy place? Is this just a matter of getting the government out of all this, quit with these different programs, stop trying to, incentivize new home buyers, start just allowing the free market to operate, which one could argue that a free market doesn't really exist anymore in most parts of the world, the U.S. being chief among them. How can this all get resolved? Do we just need a big correction and then kind of let things rebuild from there as, markets operate in cycles and there's upturns and downturns? Is this just a regular course of one of these cycles? What are your thoughts? Melody, I'll go to you first on this one.
Yeah. So one thing I didn't answer for you, Jesse, about the fraud. Right now, the servicers, like the agencies drive everything. The government agencies drive everything, and they are giving no incentives at the moment to identify that fraud. So I just wanted to mention that you can go to the FBI. There is the False Claims Act that you can actually, if you find this, you can actually be rewarded monetarily. So there are things, but right now, nobody has been incentivized to really root out this fraud, which is my friend Danielle DiMartino Booth wrote an open letter to Scott Turner saying we have to do this, and I can help them. I know exactly where. But yes, what do we need? The government has to get out of housing. They have to get out of housing, or really, they don't have to get out completely. They need to just step back. Of course, we need programs for when someone does lose their job and they need a temporary assistance or temporary relief. But all of this intervention has made housing, just like it has made college unaffordable, just like it's made healthcare unaffordable. The government needs to get out of the housing market. And I'm not a big fan of the banks, but it needs to go back to the banks. These non-banks don't have deposits, and we are about to see them implode. Now, that'll take some time, but they're about to have a very rough first quarter with these lower rates, means they have to write down their servicing assets. So yes, if the government would leave it alone, we would see real price discovery.
And Jack, your thoughts on how this whole fiasco could be resolved?
I mean, let's simply put, the housing market is lost. It's lost its way, right? Entire generations priced out. The market is just frozen. There's almost no transactions, and yet prices are still up in the stratosphere. The market is just lost. And what do we tell kids to do if you're lost in the woods or if you're lost at the theme park? We say, just sit put, do nothing, stay where you're at. And I just wish the government would do the same thing and the Fed would do the same thing. Take your hands off the panel, stop pushing buttons, watch your instrumentation, and wait for the system to settle. I don't know why this is so hard. I mean, I get why they do it, because home prices going down, stocks going down is bad for people's poll numbers. It makes the public angry. But every time they mess with the panel and every time they start pushing buttons, what they end up doing is pumping more money into the system in order to keep the home prices inflated, and that causes consumer price inflation. And right now, people are angry not because homes are going down or stocks are going down, but because they can't afford life because of what they've done with the inflation story. So the government really needs to just stop. They need to do nothing. Let the price discovery happen. And I think I understand what that means. Most people don't understand what that means. That is catastrophic for the average person. That means retirement accounts going up in smoke. Because for the last few years, as the money supply has been expanding, like I said earlier, what's been happening is all of these toxic assets, commercial real estate, private equity funds, homes, MBS, all of this crap, it's not sitting on the balance sheets of banks, as Melody pointed out. All of these non-banks have been repackaging and rehypothecating this garbage, and they've been parking it in pension funds. Because the government won't bail out the banks. That's not good with the population. That doesn't poll well. The government won't bail out private equity funds, but the government sure as hell will bail out pensions. They will bail out people's retirements. And so the longer this goes on, the more this game of the floor's price discovery keeps getting played on Wall Street, the worse this gets for the average person. And what they're doing right now, and they're doing it in plain sight, everybody can see it. Even just last week, they were talking about how BlackRock wants to open up private credit to the average investor. Oh, we want to democratize finance. No, that's not what he wants to do. He wants to park toxic sludge in people's pension plans. That's what he wants to do. And they need to stop doing this before it gets even worse. They just don't know how to do nothing. And that's the biggest problem. Let the correction happen.
So is this a complete hands-off moment when it comes to people who may be interested in investing or speculating in the real estate market in the US? Is there any corners of the market right now that maybe are not being paid much attention to that could offer some opportunity? Or would you be completely on the sidelines at this point, Melody?
Start a grass cut company. There are things you have to, when a loan is delinquent on a bank or non-bank's balance sheet, you have to cut the grass every 30 days. There are ways to benefit, from this. You can start looking at foreclosed properties. There's a program out there called Property Radar. They don't sponsor me, but it's a good program to track things like those tax liens, property liens, things like that. But no, there's nowhere right now, Jesse, because I just had a follower tell me he went to an auction of 14 properties. And what happens when you go to those auctions, just really quickly, is the banks are told to bid total or the banks or non-banks to bid total debt by the agencies because the agencies believe they can bring that property back, sell it at a profit. So they're not out there trying to auction these things right now for lower prices. So it's just not time. Last year, everybody asked me where to invest. The only place left that had not seen astronomical price increases was the Midwest. And and speculators descended on the Midwest. We're still reeling from that. And so that market's gonna take longer than the others to kind of turn around. But right now, no, I don't believe there's any corner of the market to really invest, but you can start thinking about what does all this delinquency mean? And that's where a grass cutting business comes into play. I know several people who made a lot of money last time.
Very interesting. Jack, your thoughts?
As I mentioned earlier, I see the biggest focus and concern on Wall Street is the avoidance of price discovery. And when the market is jumping through hoops like that to avoid finding out what things are worth, it means I don't want to be owning it when we finally do find out what things are worth. So I have sat out the most rip your face off rally in stocks in history. I've been largely out of stocks since the middle of 2022. I've been buying gold, silver, Bitcoin, and largely cash, T-bill, and chill. And I've done pretty well doing that. My risk exposure has been a fraction of what it would have been if I stayed in stocks. If I had YOLO'd into NASDAQ zero DTE options, I probably would have done better, but I'm comfortable with my current risk profile. Even Bitcoin, I'm getting less comfortable with that because I see a lot of the infinite money glitch with Michael Saylor and things like that that are going on there. GameStop is now getting in on that bandwagon, and crypto winter probably 6, 7 months out tops at this point. There's if you go by the historical trends, there's usually some kind of big blow up about 18 months after the previous halving. That's coming up here. So, I may be trimming my risk exposure there in the near future, although my Bitcoin is part of a multi-year strategy, so I may just set it and forget it. But as far as anything else, when I see everybody trying so hard to avoid finding out what something's worth, I sure as hell don't want to be the one buying it. So.
Well, this has been a fantastic conversation. Once again, very much appreciate you both coming on. Jack, tell us about the Nobody Special Finance YouTube channel.
My channel is called Nobody Special Finance. I do a live stream every morning at 9 a.m. Eastern Time, just doing the financial news and market conditions of the day. I also do the occasional investigative report on things like fraud in the AI industry, which is running rampant and coming to a head rapidly. And I'm also on X at JG_nuke.
Great. Those links will be in the description below. Melody, tell us about the M3 Melody Substack, what it is you do there and where people can find it.
Sure. So as I said, I track almost 90 markets every week for inventory, things like that, including listings for sale, listings for rent, prices, sales, all that jazz. But I also tie this all together with my experience in the mortgage market and how that's going to impact the housing market. And people get confused about those two things. So I do that. I try to write each week full of data, full of news stories that are relevant, kind of non-traditional. So I encourage people to check out even the free version. I give away a lot of data. I also have a YouTube, M3 Melody YouTube, and on X Twitter, you can find me at M3_Melody.
Great. All those links will be in the description as well. Thank you both once again for coming on and sharing your knowledge with the audience, and I look forward to doing it again in the future.
Thank you so much.
Jesse. Always a pleasure, sir. Melody, a pleasure as always.